Hi, today we're going to be talking about prepaids. With prepaids, this is a form of adjustment. In the text, you'll see that there are basically two forms of adjustments, prepaids and accruals. With prepaids, the cash event occurs before the accounting event in terms of revenue or expense. The simplest form of prepaid is when you prepay for a service. And what we're going to do is we're going to talk about three types of prepaid expenses and one type of prepaid revenue, which is usually called unearned revenue. With a prepaid service, and this could be, in this case, an insurance policy, it could be prepaid rent, you could prepay a magazine subscription, but in any case, what happens is you have paid for a service. So you've paid cash for a service, but the service has not been rendered to you yet. And because you have not received the service, the accounting person thinks that you shouldn't record the expense. What happens with a prepaid service like prepaid insurance? In this case, we have a 3-year insurance policy for $15,000. So the debit here, when you actually pay for the insurance policy, creates an asset called prepaid insurance. Here the asset is worth $15,000. You've paid cash for it. Here's the T account showing a $15,000 debit balance. Now, let's say it's the end of the year. So this is December 31st. 1 year has passed. So what's happened is you have received 1/3 of the service. And so you should recognize 1/3 of the expense associated with the service that you purchased. So here's what happens. At the end of the year, you recognize a debit to insurance expense, and now you credit the prepaid insurance account for $5,000. And this is a pattern we're going to see again and again and again. As the asset goes away, the expense comes about. Now the asset is worth $10,000 at the end of the year, and you're going to expense that over the next 2 years. Now, the flip side of a prepaid service is an unearned revenue. This is also considered under the category prepaid because instead of paying for a service in advance, you are receiving money for a service you have not provided yet. So we can look at the insurance company side of the transaction we just looked at. Here, the insurance company receives $15,000 for the insurance policy. So it's a debit to cash. That's the money they received. Now they have not provided the service yet, so they cannot recognize it as revenue. Instead, you credit a liability account called unearned revenue. Here's the T account for unearned revenue, $15,000 at the beginning, just like the prepaid asset was $15,000 for the person who purchased the service. At the end of the year, again, 1 year has passed, so 1/3 of the insurance policy has elapsed. What that means from the insurance company's standpoint is that you have provided 1 year of service. So you get to recognize 1/3 or $5,000 in service revenue. We also reduce the unearned service revenue account by $5,000. So this is parallel to the prepaid expense. The liability goes down because if you think about it, this unearned revenue is a liability to provide in the future $15,000 worth of service. You have provided $5,000, so the liability account goes down by 5, and you get the revenue in that year. So for service activities, prepaid expense has an exact parallel in an unearned revenue. Prepaid expense is for the person purchasing the service. Unearned revenue is from the standpoint of the company rendering the service in the future. Now, in terms of prepaids, there are also two other situations. One would be a situation where you prepay a short-term physical asset. This general classification is here you're prepaying physical assets instead of services. So in this case, let's say we're buying supplies. At the beginning of the year, we purchased $15,000 worth of supplies. That's a debit to supplies, that's an asset, and a credit to cash. Notice, just like before, we're debiting an asset account, crediting cash. Okay? So we debit the asset, we credit cash, our supplies account now has a balance of $15,000. Now at the end of the year, we take an inventory of supplies. We find that we only have $250 worth of supplies left. Another way of saying this is that we've used $1,250 of supplies during the year. So the adjusting entry, again, is a debit to expense and a credit to the asset. Notice in the problems in the text, they're going to tell you one of two of the items in red. They'll give you the beginning of the supply account and they'll either say supplies used during the year was $1,250, in which case they're giving you the adjusting amount directly, or they're going to tell you that at the end of the year the supplies account had a balance of $250 and therefore you're going to have to calculate the amount of supplies used during the year. In any case, the adjusting entry is always for the amount used. So just like in the previous example, we expense the asset as it goes away. Now you can also prepay long-term assets. However, with long-term assets, the situation is a little bit different. With long-term assets, the purchase looks identical. Here we're buying a piece of equipment for $50,000, and we note that this equipment will be depreciated down to zero over 10 years. That means every year we're going to depreciate 1/10 of $50,000 or $5,000. When we buy the asset, it's a debit to the asset account and a credit to cash. Later, we're going to reduce the asset account. However, with long-term assets like equipment or buildings, etc., we don't reduce the asset account directly. Rather, we create a contra asset account called accumulated depreciation. So the adjusting entry at the end of the year would be a debit to depreciation expense for $5,000 and a credit to accumulated depreciation for $5,000. Notice we've created this contra asset account. Notice our equipment account still has a balance of $50,000. To make this more clear, let's compare the two transactions on the balance sheet. Under short-term assets, the supplies account has declined to $250, and we just have credited that account directly, and so we put the ending balance on the balance sheet directly. For long-term assets, we record their historical cost at the top, we subtract accumulated depreciation, and we report the net amount of the asset. So in effect, the asset has been reduced by $5,000, but it's the original amount of the asset is kept in place. Now, why the different treatment? Why don't we just credit the equipment account for $5,000? The logic is that here, where we actually credited the supplies account by $1,250, the supplies have actually gone away. We've actually used the supplies up. Here for the equipment account, that piece of equipment is still sitting on our floor. It hasn't gone anywhere. So the notion is what we do is we keep that equipment on the books. We just show how much it's depreciated and report the net book value of that equipment, in this case $45,000. When this equipment is depreciated all the way down to zero, in other words, when the equipment account is 50 and accumulated depreciation is 50 and the book value is zero, that equipment will still stay on the books, and it will stay on the books until we either sell it or we dispose of it. So that's prepaid expenses and unearned revenues in a nutshell. In another video, we'll talk about the other class of adjusting entries called accrual.